All right. So on October the 1st, we purchased from UK Imports. So we got merchandise inventory. And don't worry about the reference number. This is in the amount of $14,448. And it says that we bought it on an account. So that would be accounts payable. And this time we're going to do UK imports. So every time we buy from somebody, we're going to put who we're buying from on the end. And the reason why we're going to do that is because as we pay them, we want to make sure that we're using the correct information. Okay, so let's talk about what it tells us. It says we purchased merchandise from UK Imports Company for $14,448. FOB destination net 30. FOB destination means that whoever we're purchasing from is paying the shipping. And net 30 means that the full amount is due within 30 days. Okay? As we go through these, I'll explain each one. So on the 3rd, it says that we purchased merchandise from Hoagie Company. FOB shipping point. This means that we have to pay the shipping. Okay, so shipping point means that the buyer pays the shipping. Destination means the seller pays the shipping. So this is going to be merchandise inventory again. For $99.50. Accounts payable. Remember, we indent our credit. Hoagie Company. For the same $99.50. But they give us some additional information in the instructions. It tells us that this is FOB shipping point 210. So if we pay them within 10 days, we'll get a 2% discount, or net EOM, end of the month. That means we are going to pay them at the end of the month. So the prepaid freight of $220 was added to the invoice, okay? So we didn't pay the freight. The company paid the freight, and they're going to add that to our invoice. So everything that we purchase for our merchandise, including shipping and handling, is going to be part of the cost of our inventory. So we're going to have merchandise inventory for $220, and then we're going to have accounts payable, again to Hoagie, for the $220. And the reason why I'm separating these is because when we pay in a little while, we're going to pay within that 10 days, and we don't get a reduction of paying early from our shipping, only from the cost of the merchandise. So on the 4th, we purchased from Taco Company. So again, we bought merchandise. And we bought $13,650 worth. And that's going to be accounts payable. Taco Company. For that same $13,650. And let's see what it tells us in this note. It says terms FOB destination. That means the seller is paying the shipping. And if we pay within 10 days, we get that 2% discount, or in net in 30 days. And on the 6th, it says that we issued a debit memo to Taco Company for $45.50 of merchandise returned. So we returned part of the merchandise that we got from them. Maybe it was spoiled, maybe it wasn't the right merchandise. Whenever we return something, we reverse the transaction that we just did. So it's going to be accounts payable is going to get debited, because we're taking this back out of what we owe them only for the amount that we returned, which was $4,550. And we're taking it out of our merchandise inventory with a credit to merchandise inventory for that same amount. And then on the 13th, it says that we paid Hoagie Company. So we always clear our books for exactly what we owe the company, and then we handle any kind of discount they give us. So what did we owe Hoagie Company on the 3rd? We owed them the $99.50, right? Plus the $220 shipping, right? Anybody? So we just add that together, and that's what we clear our books for. We clear our books for exactly what we owe. Yep, 10,170. Now we're paying them with cash, right? Okay, so how much are we paying them? Well, it says that they're going to give us a 2% discount. So we're going to do the $99.50. And if they give us a 2% discount, we're paying 98%, right? Plus the $220. We don't get a discount on the $220, so we add it in the end. So we do the $99.50 times the 0.98 plus the $220, sorry. So that's $99.71. The other part is going to be a credit to our merchandise inventory for the discount. The reason why we as a purchaser record our discount like this is because we didn't pay $99.50 for our merchandise, did we? We only paid 98% of that. We got a discount for the difference. So we just take the difference that we have and we subtract it from our 10,170, or you can figure $99.50 times 2%, whichever way you want to do it, is $199. However you do it, make sure that what's on the left side of your journal entry matches the total on the right side, and it does. Questions about that, why we did it like that? And I'm just going to make a note on here so you'll know. Times that 0.02. That's how we got that. Okay, on the 14th, we're paying Taco Company. So we clear our books of what we have on there that we owe them. So we originally owed Taco Company $13,650, but we returned part of the merchandise of $4,550. So now we owe them $9,100. And did they offer us a discount? Oops, we don't want to put the discount there. We just leave $9,100. I don't want to confuse you. Okay, so then our cash, the way we calculate that is, did the Taco Company offer us a discount? They did. They said if we paid them within 10 days, they would give us a 2% discount. We are paying them within 10 days. So it would be the $9,100 times 0.98 because they're giving us a 2% discount. So that would be $89.18. So our merchandise inventory would be the $9,100 times 2%, which is $182. Questions? Do you understand why we're doing that? We will never, ever calculate our discount on shipping, ever. Okay. All right, so next, on the 19th, we purchased merchandise from Veggie Company. We bought $27,300 worth. it says that we paid freight of $400. Okay, so we went ahead and paid the freight in advance. They're not adding it to our ticket. So when we say that we paid freight in advance, it's going to be part of our merchandise inventory, because remember, it's part of getting the product to us. So it's part of our cost of $400. And it says paid. So what does that mean? We credit cash. A lot of students, oops, I didn't mean to put that on there. A lot of students will want this debit to be delivery expense, but it's not delivery expense because it's part of the cost of getting the merchandise to us. And all cost in getting the merchandise to us is merchandise inventory. Okay, on the 20th, it says that we purchased merchandise from Caesar Salad Company. It says that we bought $22,000 worth. And it says on the 30th, we paid Caesar Salad. So that was within 10 days, right? So we have to look and see if they were offering us a discount. We clear our books for the total amount we have, which was $22,000. Cash. Okay, it tells us that Caesar Salad is offering us a 1% discount. So that would be $220. So we're going to pay $21,880, right? I kind of did that in my head. Somebody correct me if I'm wrong. Maybe it's $780. I'm not sure. So merchandise inventory would be the $22,000 times 0.02. No, 0.1. So $220. I'm going to put this note on there so you'll know where this money's coming from. Okay. Yeah, $21,780. Thank you. I had to second guess myself there for a second. Okay, on the 31st, we paid UK imports. So how much did we owe UK imports? So we're going to do accounts payable. We had on the books that we owed them $14,448. They didn't offer us a discount, so it's just straight payment. And then on the 31st, we paid VeggieCo. And we owed them $27,300. And did they offer us any discounts? They did not, just end of the month. So that's in the amount of $27,300. So some students think that end of the month means within 30 days, but end of the month means within end of the month. If it's net 30, it'll say net 30. EOM means at the end of the month. If you bought it on the 22nd, they still expect you to pay them by the 30th, okay? All right, so that's how we do purchasing entries and the math behind it. Remember that I told you that the page in your book that would be your friend was page 280, exhibit 14, because it shows transactions both from the buying and selling perspective, from the perpetual inventory side, and then also on page 268, which is really great because it gives you a list of transactions and then shows you what they would look like. All right, so we're going to go ahead and move on. I'll save this. You don't have to submit this. This is just for you, but I'll save this and you'll be able to go back in and look at the recording later. So I'm going to go ahead and open our next problem, which is going to be 6.2a. And it's a journal page. So this 6.2a is from the seller perspective. We just did as the buyer, we were buying products for our store. Now we're going to do it as the seller's perspective. We're actually selling products. So this is on page 298 as well. We just dropped down, and this is for Amsterdam Supply Company, and we do office supplies primary to wholesalers and occasionally to retail customers. So it already has the dates on there for us. So our first time that we sold anything. Remember I told you on Tuesday, any time that you make a sale, you must have a 4-part journal entry. It's going to be how you made the sale, either for cash or accounts receivables, sales, and then cost of merchandise sold, which takes the merchandise out of your inventory and creates an expense, and then a credit to merchandise inventory. So we sold to Equinox Company. So accounts receivable, Equinox, $18,900, and credit to sales for that same amount, $18,900. Now next, the problem tells us that this merchandise cost us $13,300. So cost of merchandise sold, now it becomes an expense to us. So we're moving it from an asset to an expense by crediting merchandise inventory. Okay, so then it says on the third that we sold merchandise for cash for $11,350 plus 6% sales tax to a retail customer. The merchandise cost us $7,000. When we collect tax, do we get to keep that? No, we do not get to keep that. So for cash, we receive the $11,350 plus the 6%. So I'm going to write a formula in here that says, open parentheses, 11,350 times 0.06, close parentheses, plus 11,350. What's inside the parentheses is just calculating our tax. We have to add the 11,350 on the end, because if we don't, we'll only have tax. And we need to know what the purchase price plus tax is. So it's $12,031. So we have sales of the $11,350, and then we have a liability account where we collect our sales tax payable, and that's just for the difference. You can have it calculated again if you want to. I just am lazy and I'm having to do the math, or maybe I'm not. Okay. So we collected $681 in sales tax. We still have to continue on with the second part of the transaction, which is cost of merchandise sold, which they told us was $7,000, and merchandise inventory of $7,000. On the fourth, it says that we sold merchandise on account to Empire Company. So accounts receivable, Empire. We sold them $55,400. Hope they pay us soon. That's a lot of dollars. We're going to credit that to sales for that same $55,400. And then we're going to do the same thing, cost of merchandise sold. That merchandise cost us $33,200. And merchandise inventory for the same $33,200. So to find out our gross profit of this sale, we would take sales minus cost of merchandise sold. On the 5th, we sold merchandise to a retail customer again on MasterCard. MasterCard is same as cash to us, except for we have to pay the company for using their card, for $30,000 plus 6%. So that would be $31,800. To have a credit to our sales for the $30,000, and a credit to sales tax payable for the $1,800. That's not our money. A local restaurant in Hope went out of business because they were collecting sales tax, but they weren't paying them in by the 15th of the following month. So Uncle Sam shut them down. So we're going to do cost of goods sold. That merchandise cost us $19,400. And we'll do a credit to merchandise inventory for the same $19,400. Everybody with me? Y'all understanding? Comments, complaints, mercies, any of that good stuff this morning? Okay. I'm going to say y'all grasping it. Okay, so Equinox Company gave us some money. Yay, we're getting money. So when we get money, we get cash, right? So how much did Equinox Company owe us? They owed us $18,900. We said, hey, if y'all pay us within 10 days, we're going to give you a 1% discount. Is it within 10 days? Yes. So they're going to pay us $18,900 times 0.99 because we gave them a 1% discount. So we're then going to have sales discounts because we're giving the discount. The sales discount is the difference between the $18,900 and the $18,711. We always take it off of our books for exactly what they charge. So they charge the $18,900 because we don't ever want anything out there in accounts payable. We want to clean that up every time. Okay, on the 14th, we sold merchandise to a customer who used American Express. Again, same as cash. In the amount of $13,700. And we have a credit to sales for that same amount. And then we are again, every time, cost of merchandise sold. The merchandise cost us $83.50. And a credit to merchandise inventory for the same $83.50. Okay, on the 16th, it said that we sold merchandise to Target Company, accounts receivable to them for $27,500, sales to us for that same amount. Our merchandise, cost of merchandise sold was $16,000. And merchandise inventory for the same $16,000. Then on the 18th, it says that we issued a credit memo to them. So they returned part of what they bought from us, okay? When they return to us, we do the opposite of the transaction above. So we got our merchandise back, right? So we're going to have sales return and allowance. This is a contra account to our sales, okay? So we have to show we're getting this merchandise back. That would be $4,800. And we're going to have a credit to accounts receivable for Target because we want to take off the books at $4,800. They no longer owe us $27,500. They owe us $27,500 minus the $4,800. Now we put it back into our merchandise inventory for the amount that it's valued at, $2,900, and take it back out of our cost of merchandise sold for that same amount. Otherwise, our expenses would be overstated and our assets would be understated. On the 19th, we sold to Vista Company. So we have accounts receivable Vista for $82.50 and sales for the same $82.50. And then we have cost of merchandise sold of $5,000. Oops, I'm missing something. Oh, okay. It says they added $75 to the invoice for prepaid freight. So we have what do you think goes here? They owe us an additional $75. Do we credit that to sales? What do you think? Who paid it? We did, right? It says prepaid freight. So we're crediting it to cash because we actually paid for it in advance and we added it to their invoice, and when they pay us, they'll pay for their merchandise and the freight at one time. Okay, so now we're going to credit to debit to cost of merchandise sold for the $5,000 and credit to merchandise inventory for the $5,000. Now, when they get their sales discount, when they pay us, do they get it on that $75? No. On the 26th, we receive a check from Target Company, so we're getting some cash. All right, so how much did they owe us? They owed us $27.5, but they returned $4,800, and we're giving them a 2% discount. So it's going to be a big formula. So it's going to equal less than $27,500 minus the $4,800 they returned, close parentheses, times the 99 because we're giving them a 1% discount. So that would be a debit to sales discounts. So we're going to write that formula as well. It's going to equal the $27.5 minus the $4,800 times 0.01. Oops, I went wrong. Happens. I did. Thank you. So that's going to be 27.5 minus 4,800, close that parentheses, times 0.01. All right. And then we're going to clean the books up for exactly what they owed us, which was $22,700. Okay, on the 28th, we received a check from Vista Company. Mercy, we're getting paid. We know we're going to give them a sales discount, and we're going to credit for the full amount that they owe us. So what did Vista owe us? Vista owed us the $82.50 plus the $75 for freight. They're going to pay us the $82.50 times, oops, what discount are we give them? 2%. Plus the $75 they owe us for free. Yeah, I want you to fix it. $82.50 times 0.02 plus, this is supposed to be a plus, not a multiplication. How about that's our discount? How about I don't know what I'm doing? So let's see, $82.50 times, we're giving them a 2% discount plus the $75. Oh, that makes a lot more sense. All right, so the difference between these two is our discount of $165. Sometimes I get too happy with my formulas in Excel. All right, so we received a check from Empire Company from the sale on the 4th. So Empire gave us cash. Check, Visa card, all same as cash. Empire owed us $55,400. Thank goodness they paid us because that's a lot. All right, on the 31st, it says that we are going to pay for delivery services. So we're going to have delivery expenses, and we paid, so that's a credit to cash, correct? $5,600. I hope we added that to their cost. On the 3rd, we have to pay the credit card company because they don't let us use them for free, right? So we have credit card expense of $940. Do y'all know which is the most expensive credit card for a company to use? American Express. And the second in that is Discover. And then we have to pay those sales tax we've been collecting all month because that's not our money. So we have sales tax payable of $65.44 and a credit to cash for that same $65.44. That was so easy, right?
No.
What?
easy, yeah, because you're sitting here, but at home,
That's why I'm recording it. So when you get home and you forget what I told you, you can pull it up and watch it right beside your problem. You're welcome. $5, please. All right, so we're going to look at 658 because we still have some time, and hey, there's no need in wasting time. So 658 is on page 300. So I'm going to drop down and get that spreadsheet. Maybe we'll get through all of them, and then we can just come back next Tuesday and go over what you don't understand and didn't listen to on the video. All right. So now we're going to do an income statement. And before we did our income statement in accounting form, but now we're going to do it in report form. Our balance sheet, sorry. So we're going to start with our income statement, and this income statement is a multi-step income statement. The first thing we're going to do is put our date, and we know it's for the year ending. So now we're going to handle our sales accounts. The first thing that goes on here, this is page 300, the top of page. We're working, sorry, I didn't tell y'all, for, oh, I don't know. Y'all tell me the name of this company.
You said 65A?
65A, top of 300. Gloucester? Is that what it is? I don't know. Dyslexic me cannot read, so I'm going to leave that to y'all. All right, it says that our sales, but I like numbers, is $4,576,000. I'm zoomed in so far that it's not going to show y'all the numbers, so I'm going to zoom out a little bit. All right, so whenever we have our sales, we have to deal with those contra accounts to sales. So those contra accounts are sales return and allowance and sales discounts, because this offsets what our sales were. Whenever we give a discount or someone returns something, we have to take that back out of our sales. So it's $31,000 and $28,000. So that's a total of $59,000. We subtract that from sales to get net sales. And then we're going to subtract our cost of merchandise sold to track our expenses, which was $2,650,000. The difference between our net sales and cost of merchandise sold is gross profit, and that's on your final exam. That question is, how do you calculate gross profit? Okay, so now we're going to handle our expenses. We've broken our expenses down to selling and administrative. I like to just drop down and then go fill them in. You can do them however you want to. Our first expense is sales salaries. Our next expense is advertising expense. Our next expense is depreciation store equipment. And then good old miscellaneous selling. We always list it last. So we had 745, 205, 40, and 18. Whoops, not 180. For a grand total of $1,008,000. And we'll do the same thing with our advertising expenses. So for advertising, we had office salaries. Then we had rent. Got to pay for that rent of our building. Then we had depreciation of office equipment. I have depreciation on that printer, copier. And then we had insurance expense. Lord knows we got to have insurance. Somebody fall in our store and try to sue us. Office supplies expense. And finally, miscellaneous. Oh, yeah, miscellaneous. We're going to deal with that interest expense later that you see hanging out down there. That has nothing to do with the selling or administrative, okay? So we're going to start out with 410, and then we got 60,000, and then 30,000, 18,000, 11,000, and 8,000. For a grand total of 537,000. We add our two expenses together to come up with a grand total of $1,545,000. The difference between our gross profit and our selling and administrative expenses is our income from operations of $322,000. Boy, we were doing good till we took all them expenses out. So other expenses that we had, it says that we had an interest expense. So obviously some loan that we have is carrying a pretty nifty expense of $12,000. And so the difference between those two gives us net income of $310,000. That wasn't bad at all, was it? I know what you're going to say, Ebony. That's because you were here, Miss Maiden. And I feel like we're on a roll this morning, so we might as well roll on over and knock out 10A. Periodic inventory multi-step income statement with closing entries. I like closing entries. Let's just shut the door on that.
So we're not gonna finish it. That's just too long.
Oh, man, I got too happy. We got to do some of his owner's equity. I was trying to knock this out. Okay, Mia, here we go. All right, so good old Mia here. It says that she had beginning capital of $675,000. We're still going to make it work. Then we had net income from the income statement above of $310,000. And then we took some money out because we had to pay ourselves of, see how good we pay ourselves. Ooh, yeah, girl, we pay ourselves good, $75,000. So then that gives us an increase in owner's equity between the two. So 310 minus the 75 is 235,000. Plus our beginning capital gives us ending capital of 910,000, just short of $1 million. I like what she's doing. All right, so our balance sheet, we know that's going to have a terminal date. So that terminal date is August the 31st. This is when our balance sheet changes in merchandising. Before we had seen our balance sheet where it was horizontal, it's now vertical. So it's in a report form versus account form. So we gotta list those assets first. First asset we know is good old cash, which I can't never seem to keep enough of. Accounts receivables, merchandise inventory. That's our new asset because we are a merchandising business. Office supplies and prepaid insurance. So we'll tag those amounts, 125, 335. Some people need to be paying those. 380, 12,000, and 9,000. So our current assets are a total of 861,000. Now we'll handle property, plant, and equipment. Our office equipment's cost was $275,000. And then we'll do our accumulated depreciation for office equipment, which was $187,000. Our office equipment ain't worth much now. Our book value of our office equipment is now currently $88,000. Our store equipment was $859,000. Less accumulated depreciation store equipment, $293,000. The difference between these two gives us the book value of our store equipment. So our total property, plant, and equipment is $654,000. Our total assets we add together, current assets and property, plant, and equipment, is $1,515,000. All right, so we're moving right along to our our liabilities, because Lord knows we got to pay people. All right, accounts payables, first up. It's at 193. Then we have salaries payable of $12,000. Oh, they want us to do notes first. So we're going to handle notes payable. The current portion of our notes payable, okay? So it says notes payable is $400,000 due by 2037. But the current portion, it tells us in step 3 of the instructions, is $16,000. And then we handle our accounts payable. Salaries payable. I want it to be all kinds of things today. which was 12,000. We add all those up, and our current liabilities is 221,000. Our long-term liabilities is that note portion minus what we currently paid on it. So that makes us go down to 384,000. I just took the 400,000 minus the 16,000, and that's the difference. We add these together to find out our total liabilities of 605. We get our owner's equity right off our owner's equity statement of $910,000. We add those two together, and it equals, they're balanced, $1,515,000. On 4A, it says, explain how multi-step and single-step income statements differ from report form. Well, first of all, they're vertical. Second of all, we list out our assets, and then we handle our property, plant, and equipment, and then, of course, we have our current liabilities, and on this, we list long-term liabilities. On the account form, we don't list out long-term liabilities separate. And the second part says how report form and account form balance sheets differ. Oh, I answered that all at one time. Okay, you're welcome. Okay, so we can move right along now. Is that okay with everybody?
Yes, ma'am.
Since we're rolling, we might as well keep rolling. All right, let's pick up good old 10A. This is our multi-step income statement again, but this time they want us to do the closing entries. We're not scared of closing entries. So I'm going to zoom this up a little bit. Okay, so it says Wyman Company uses which type of inventory system? This is 10A on page 301. It's a periodic inventory system, multi-step income statement. Which type does it use? Periodic. What does periodic mean? We do a physical count. Periodic means we do a physical count of our inventory. We're not counting it as we go. When we get to chapter 7, we'll be talking about LIFO and FIFO. And so we'll need to know whether it's a periodic or we're counting it as we go, which is perpetual. For the end of the month, start out the same way we did before, sales. And then we list our contra accounts to sales, which is sales return allowance and then sales discounts. I'm going to try to zoom it in just a little bit more for y'all, but sometimes it'll skew the numbers, so we'll just have to see. Okay, so our total sales for this problem was at the bottom, $3,355,000. And it did skew it. Okay. And our sales return was $46,000, and our discounts was $29,000. We add those two together to come up with $75,000. We subtract that from our sales to come up with net sales of $3,280,000. We subtract our cost of merchandise sold, so that's our expense. Uh-oh, they threw a wrench in. Okay, so we haven't talked about this yet. This time they're adding our purchases here, and then we have purchase returns and allowance and purchase discounts. So we have purchases of, no, we're going to have purchases first. We have purchases of $2,650,000. No, they don't want us to do it like that. All right, let me think for a second. How do they want us to do it? They want this to go here. And that's 265,000. And this is going to be, we have a beginning cost of merchandise sold. Yep, January 1st. That's our beginning. So they're making us do beginning plus what we bought, subtract the ending to find out what our balance is, and this is exactly how it would be done on the books. Okay, so we had some returns of $93,000, and we had some discounts of $37,000. So our net purchases is going to be this minus this minus this. Okay, so now we're going to have our ending, wherever it's hiding. Oh, no, we're not. JK, JK. Merchandise inventory on December 31st was 305,000.
That's crazy. That, where you have to inventory, that first week, you get one, two, three.
Yep, we got to count for that good old freight charges. So our freight in was 48,000. So the two of those combined accounts for the merchandise purchase that we made of 2,568,000. So our merchandise available for sale was our beginning plus what our purchases were, including freight, minus our ending will give us the cost of merchandise for this period, which was 2,520,000. We subtract that from sales, and it will give us gross profit. Okay, so that was what was added to this. The actual, instead of just giving us the cost of merchandise sold, they're making us calculate it by using the beginning plus our purchases minus our returns and allowance minus discounts plus the freight, because that's cost part of our merchandise inventory, minus our ending. All right, so we can move right along to our expenses. So our sales expenses is going to start out with Skiddo salary. Which is hiding at the bottom. And then we had advertising. And then we had delivery. And then depreciation. And finally, miscellaneous. In the amounts of 300,000, 45,000, 9,000, 6,000, not 60, and 12,000. For a total selling expenses of 372,000. And then we move right along to advertising. So we had office salaries expense. In the amount of 175,000. Then we had rent expense. In the amount of 28,000. Then we had insurance. Office supplies. I think it's easier to go this way. And then we had depreciation. And finally, miscellaneous. So 3,000, 2,000, 1,500, not 15,000, and 3,500. We add all those up for total admin of 213. We add both together for total expenses of 585. We subtract that from our gross profit to give us income from operations of 175,000. So then we have a couple of things here. We have some rent revenue and some interest expense. So our rent revenue is 7,000. And our interest expense is 2,000. We offset that for a $5,000 increase. So 180,000 is our net income. Okay. The next part, they want us to do the closing entries. So the closing entries that we would do would include all of our expenses and all of our revenue. So we'll start out with our revenue. So we're going to close our revenue to the income summary. with a debit to our revenue account.
There's that asterisk.
Yeah, that's what we're supposed to credit. So we want to record the debit to the inventory on this line. Select accounts from the drop-down list. So our merchandise inventory was 7,000. Oh, let's go back up and find it. Merchandise inventory. That's what we got left, 305. And then we'll do the remaining accounts in the same order. They're presented on the income statement. So, the remaining accounts are, what goes next? So sales is our next revenue account, and our total sales was $3,355,000. Our next account is our no, that's not revenue. Are you talking about cost of merchandise sold? Yes, because that's money back to us. Purchase returns and allowances and purchase discounts is money back to us. So 93,000. Because that's money that comes back to us that we don't have to pay out. So it's revenue. And then the last revenue is good old rent. And our rent revenue was 7,000. So our total revenues are 3,797,000. We close our expenses out to the income summary with a debit. And do they make us list them all out? They do. So I'm just going to copy and paste. And they're not going to go in that order. So I'm not going to do that. JK, just kidding. Okay, so they want us to record the credit to the inventory on the list first. So this would be our merchandise inventory. Bless you. And then we're going to have sales return and allowance, because that's an expense to us when somebody brings something back. Oops, I had that on there. So just to save time, I'm going to tell you how these go. Sales return allowance, sales discounts. Then after our sales discount, we're going to have our purchases. And then after our purchases, we're going to have our freight in. And after our freight in, we'll list our other expenses. Copy. which is going to be our sales salary. All the way down. Come on, little thing. So we got our sales salary, and then we're going to have our advertising, and then we have our depreciation of store equipment. Oh, that's out of order. Let me go look at them. Delivery, then depreciation. Delivery, depreciation, store equipment, and then miscellaneous. And then we'll start off with our office. Office salaries. And then after office salaries, we have rent. And after rent, we had insurance. Then office supplies. After office supplies, we had depreciation. Then after that, we had, what was that last two? Depreciation, office equipment. Then we had good old miscellaneous. And we had interest expense. Yep, they want us to do that. Okay, and I'm going to go up and copy these down. So I just copy and I bring it down and paste. That was 2,000. Now I can go back up and get my merchandise inventory, which was 257. And sales return and allowance. And then our purchases. And our freight in. So finally, we got them all listed. Total expenses of $3,617,000. Then we're going to close out the income summary to the capital account, just like we did in chapter 3 and 4. Credit to our capital account. For the difference between the credit to the income summary and the debit to the income summary. So that's $180,000, same as saying net income. And then we're going to close out our drawing account to our capital account. Only time that we debit our capital account, we pay ourselves well. We paid ourselves $25,000. And that would be a credit to the drawing because that's how we close it. And that same $25,000. Net income under the perpetual inventory system would be what? Huh? It doesn't change if you count it as you go or if you do a physical count. It's going to be the same unless you're using FIFO versus LIFO. That's the only time that'll change. Bless you. Okay, so yay, we did it. Just under the bell. We got all of them in. Questions? All right, I'll post this video out there for you. You know, it usually takes it a while before it actually buffers. So you can go back and find it in your recording.